Just keep buying. Part 5. Is buying in a market crash an opportunity or a trap? On the morning of March 23, 2020, Sameer opened his portfolio. In just a few weeks, the market had fallen by about 1/3. There was a lockdown outside, and inside, his savings were melting away. His finger was on the sell button. Just then a question arose: what if the job is also gone? But the other fear was deeper. What if this is the cheapest opportunity and he ran away? A few months later, the market returned to its old high. But on that dark morning, nobody knew this. In front of Sameer was not the future, but only fear and incomplete information. So is buying in a crisis bravery or a dangerous gamble? Is every crash an opportunity to build wealth, or does a falling price sometimes lead us straight into a trap? In the previous part, we learned that a correct asset allocation and a long time are more important than finding a perfect entry date. For market timing, both exiting and returning must be correct. We also understood that trying to completely eliminate volatility can keep growth away too. But seeing a decline on a chart and living through a real crisis are absolutely different experiences. In a crisis, not only do share prices fall, businesses can shut down, credit can become expensive, news increases fear, and danger begins to loom over future income as well. Right here, the hardest truth of investing comes forward. At the very time assets look cheap, your human capital, job, business, and earning capacity can also weaken. In the COVID-19 crash, the S&P 500 fell approximately 34% from its February 2020 peak until March 23. The world then had no idea of the length of the pandemic or the economic damage. Then the same index crossed its old high on August 18. This recovery happened in about 5 months, but it would be dangerous to consider such a fast return as a template for every future crash. In that period, central bank support, government stimulus, extremely low interest rates, and the hope of the future opening up changed sentiment. In the next crisis, circumstances and policy responses could be absolutely different. Today, the March bottom is clearly visible in the old chart. In real time, that bottom was not written. On that day, nobody knew whether recovery would come the next morning or a new decline. A famous saying is often linked to Baron Rothschild: the time to buy is when there is blood in the streets. But its exact origin and attribution are not fully certified. Yet the saying explains a psychological point. When fear is at its highest, prices can be low. But every low price is not cheap value. Some assets fall for a correct reason. The lesson of part 3 is extremely essential here. Buying a broad index and wagering on a single broken company in a crisis are not identical. A risk of the business does not disappear because the price falls. In a crisis, debt can weigh heavily on a weak company, new shares can be issued, or the business can shut down. It is not necessary for the old price of such a stock to return. A diversified index spreads risk across many businesses and can limit the impact of a single failure. Still, it does not give complete protection from the damage of market, country, and economic crises. Therefore, buy in a crisis is in itself incomplete advice. The correct sentence is: keep buying according to your long-term, diversified, and pre-decided plan if your financial safety is secure. First of all, save your life, not the portfolio. Without an emergency fund, insurance, control over essential household expenses, and expensive debt, aggressive buying in a crash can make you a forced seller. If the job is in danger or the business income has stopped, holding cash is not fear. In a crisis, liquidity is the shield that saves you from selling investments at a wrong time. Money needed in the next few years should not be thrown into an equity crash. The amount for a home down payment, fees, or a medical need cannot wait indefinitely for a recovery. Buying a crash with borrowed money or margin increases the risk multiple times. The lender does not wait if the price falls further. Forced selling can make the loss permanent. Then where does the money to buy in a crisis come from? The safest paths are usually contributions from regular income, a pre-decided investment schedule, and portfolio rebalancing, no emergency cash. If income is secure and the goal is far, it is not necessary to stop an ongoing SEPI. Regular investing keeps getting you units at different prices without taking the responsibility of identifying the bottom. When the price falls, more units are received from an identical contribution. Upon a recovery coming, those same units can increase in value rapidly, but only if the investment survives and you stick around for sufficient time. FINRA also explains that dollar cost averaging can reduce emotion, but does not give a guarantee of profit. If the market falls for a long time, regular buying will show temporary losses too. During the Great Depression, an investor buying continuously would have added more shares at falling prices. The subsequent recovery helped those purchases, but the path was long and extremely painful. Here it is useful to understand the math of loss and recovery. If an asset falls by half, then to reach the old price, it does not have to double, it has to become twice. Similarly, to reach back to the old level from an approximately one-third decline, a growth of about half is needed. In 2020, the S&P 500 covered this distance with extraordinary speed. But the meaning of this math is not that you will be able to buy at the bottom. The market can go further down, recovery can stall, and new information can change the entire valuation. That is why there is no need to deploy the entire remaining amount on any single day in a crisis. If a large investable cash is present, then a lump sum or fixed tranches can be chosen according to behavior. Make the schedule of tranches beforehand, how much amount on which dates and until when. The rule of "we will see the next decline" makes emotion the decision maker, and cash keeps lying outside. The second path is rebalancing. In this, you do not predict the market's bottom. You just return the portfolio close to that stock, bond, and cash allocation which was chosen before the crisis. Suppose that due to equity falling, its weight went below the target. Balance can be returned by putting new contributions into equity or by adjusting other assets according to the plan. Rebalancing disciplines you to buy a fallen thing, but this too is no guarantee of returns. If both stocks and bonds fall, the portfolio will still feel pain. Rebalancing too many times can increase tax, exit load, brokerage, or other costs. Therefore, a clear rule like a calendar or a fixed allocation band is better than daily restlessness. After a decline, the expected return can be better, because you are buying identical earnings at a lower price. But if earnings themselves fall, value is not decided just by looking at the old high. In historical data, many strong recoveries are seen after deep market declines. Yet the range of results is very large, no fixed date or annual return is received beforehand. An asset that has fallen 30% is not bound to stop right there. The next 30% decline will be from a new, smaller level. Therefore, how much more will it fall now is dangerous thinking. Japan is a necessary example of this. The Nikkei 225 crossed its 1989 nominal peak in February 2024, approximately 34 years later. Not every market gives a fast recovery like 2020. The experience of an investor deploying a lump sum once at that peak and one making contributions throughout the entire period would be different. Dividends, currency, fees, and buying dates also change the result. The story of Japan shows that with time, you should diversify geography too. Looking only at the past success of your own country and connecting the entire retirement to one market can become a concentration risk. Yet, a global fund is no magical protection. In a worldwide recession, many markets can fall together, while currency movements, taxes, and fund structures can change your actual return. In the midst of a crisis, there is no shortage of information, there is a flood of it. Every hour, a new forecast, target, and scary thumbnail appears, but more noise does not necessarily give more truth. Looking at the portfolio repeatedly does not reduce the loss, but it can increase restlessness. The red color of the screen begins to make a short-term movement feel like a lifetime failure. That is why write a crisis checklist during calm times. For which goals are you investing, how much drawdown can you tolerate, and under what condition will the plan change? This should be fixed before a crash. Before buying, ask yourself, is the emergency fund secure? Is the goal still far? Is the income sufficient? And is this purchase bringing the portfolio close to the target allocation? If the answer to these questions is not clear, it is better to pause and understand the situation. Discipline does not mean buying every day. Discipline means following the financial rules you made. A price falling and an investment thesis breaking are different events. A broad market can fall due to fear, whereas a company's decline can be a signal of fraud or a dying business. Even when the entire economy is going through a difficult period, a diversified market has both strong and weak businesses. The basis of buying should be future productive capacity, not just the old price. In an individual stock, it has fallen this much, is no protection. If the balance sheet is breaking, cash is running out, or governance is suspect, a stock looking cheap can become a value trap. That is why stock picking becomes even more difficult in a crisis. Headlines can be incomplete, estimates change, and liquidity reduce. Broad diversification reduces the risk of choosing a wrong company. For a retired investor, the story is different. When expenses are coming out of the portfolio, an initial big decline and continuous withdrawals can damage the recovery. This is called sequence of returns risk. For such an investor, it is not necessary to buy a crisis by keeping the entire money for several years' expenses in stocks. The help of a qualified advisor for a suitable cash bond buffer and withdrawal plan can be useful. A young investor may have a long time, but he too does not get infinite risk capacity. The job is connected to the same economy that can weaken during a market crash. Therefore, do not measure courage by age or confidence. Real risk capacity is formed by income, emergency reserves, dependence, debt, the date of the goal, and the capacity to stick around in a decline. Just keep buying does not mean trying to be a hero. It means choosing an amount and frequency that can be continued even in the midst of bad news, a long decline, and personal difficulties. If a contribution has to be stopped for survival, it is not a failure of investing. Securing home and health first is necessary. A financial plan is for the human is not for the plan. Investment can be restarted once the situation stabilizes. A missed month can be handled. Taking a loan in an emergency or buying a wrong asset to catch the bottom can do more damage. A market bottom is often not a clean V shape. The price can fall, bounce, and then make a new low. Considering every rebound as a recovery is an easy mistake. The real bottom is visible only later, when the market has come up significantly. Therefore, rather than a prediction, relying on the schedule, allocation, and risk limits is more practical. The goal of successful investing in a crisis is not to catch the cheapest stick. The goal is to avoid permanent loss by panicking, to secure necessary cash, and to maintain your share in productive assets. This is the real lesson of this part. Bravery is not suddenly making a big wager seeing a red screen. Bravery is sticking to the rules made before and accepting uncertainty honestly. But after a recovery, a new question will stand up. If the investment has grown, the goal is coming close, or the story of some asset has changed, then what will be the right time to sell? In the next part, we will know when it is wise to sell, when it is better to hold, and why exiting early looking at a profit can also become the most expensive mistake of wealth creation.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible, but in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.